Hi, this is John Hyre, and for a little while, I am answering questions for free and not behind the paywall that is my inner circle, which has a good deal more than just answering questions. And I say just answering questions because that normally would run you 1,500 an hour one-on-one. But let's get to it. So Jill asks, am I legally required to file Form 5500 annually for a ROBS corporation? Now, you guys know I love the rollover business startup concept, ROBS. And once I'm in North Carolina, January 2nd of 2027, I will be running my law practice and my information business through a rollover business startup. That's how much I love them. You might want to look elsewhere on the site to see why. What is the valuation based on? Fair market value of the shares or something else? All right, so we're asking about a specific form, IRS Form 5500, which is for 401ks. Let's walk through. What are the forms that need to be filed? The C corporation. So in a ROBS structure, the ideal structure, the way I like to see it, is Roth 401k owns 98% of a C corporation. The human who owns the Roth 401k owns 2% of the C corporation. That's how mine is set up. The C corporation makes money. It pays 21% federal tax, and whatever's left gets either reinvested in the C corp, stays in the C corp, or more commonly is distributed. In my case, we distribute because my business doesn't require a lot of capital. And so commonly for us, when we have money in there, we don't need a big reserve. We distribute almost everything. So 98% to the 401k, I get taxed once at 21%. Let's say I make $1 million. I pay pay 200,000 in taxes. I have 800 left over. 98% of that goes into the solo 401k. 2% goes to me. And the 401k doesn't have to be a solo, but it does need to be a Roth. Why? Because once in my example, nearly $800,000 is distributed to the 401k, it's never taxed for income taxes again, as long as I live, plus at least another 10 years. So it's a very valuable benefit. So we want to comply with it. So the C corporation files the usual corporate income tax return, an 1120, always on time and correctly. We do not endanger this magnificent structure with inferior compliance. Now the 401k needs to file a timely Form 5500. Understand, the penalties for a late Form 5500 are very high, and it is neither easy nor cheap to hire someone to get you out of those penalties. So you really want to see the Form 5500 timely filed. Furthermore, we want to always file it. Now, technically, and this, by the way, applies to any 401k, not just a ROBS 401k. Technically, if your 401k has less than $250,000 in assets, you don't have to file a Form 5500. Some people take the approach of, well, the less information I give the government, the better. I'm not filing. I think that's a mistake. It's understandable, but it's an error. Why? Because the 5500 sets the statute of limitations in motion. Once you file a Form 5500, the IRS has, depending on the issue, 3 to 6 years to audit the 401k. Let me repeat that. Once you file a Form 5500, the IRS has 3 to 6 years to audit the 401k. It's like a 1040. When I file a 1040, the IRS, depending on the issue, generally has 3 to 6 years to audit me. If I never file a 1040 for a given year, even if I'm not required to, let's say I legitimately did not file a 1040 because the instructions in the 1040 said, I don't make enough money, I don't have to file. What's the problem with not filing the 1040? The IRS can audit me into eternity, and I've seen it done. If I file a 1040, even if it's not required, they have 3 to 6 years to audit me in most cases. Same thing with a 5500, right? A 5500 is essentially a 1040 for a 401k. You want to file it. You want to start the statute of limitations. You want to limit the amount of time the IRS has to argue with you or audit you. You want to be able to sleep once that period passes. Now, I think you want to do things legitimately so that you sleep well enough knowing, look, even if there is an audit, it's annoying, it's a pain, but I'm going to win. But you want to eliminate the amount of time they have to look for things like prohibited transactions. So file the 5,500 on time, penalties for being later, very expensive, always for any 401k, and especially given how valuable a ROBS is for a ROBS 401k. Well, what's fair market value based on? Fair market value is based on the shares, in the case of a ROBS, and anything else the 401k owns. Now, the law does not formally require an appraisal, but it does informally require it in certain cases. It looks at process. The trustee, in good faith, can value the 401k. You're usually the trustee. For example, if it's a solo 401k, you are probably the trustee. You can, in good faith, determine the fair market value of the assets, but it has to be in good faith. No fakery, no BS. It's a high standard. And as long as it's solo and there's nothing major going on, so if it's solo, meaning the only owners, or the only employees, the only participants in the 401k plan are owners of the company, and as long as there's not a valuation event, such as required minimum distributions or Roth conversions, you don't need to hire someone to do the appraisal. You don't need to hire someone to figure out fair market value. You can do it in good faith. Now, as soon as there are employees who are non-owners, employees who are either not owners and not spouses of owners, the responsibility goes way up. Once you have non-owner employees, the law doesn't formally say you need to have an appraisal done. It does it informally. It basically says you're held to a standard of being reasonable and responsible and acting in good faith. And for us, that means you're going to follow an appraisal process or get an appraiser. You'll get away with following an appraisal process when you're self-valuing a solo, when you have no employees and no valuation events. So you can't just make up a number. You should be able to show, well, how did we get to that number? You really need to show how did we get to that number and preserve those documents for an audit, even in a solo. But once you get into the place where you have employees, other than yourself, other than other owners, other than the spouses of the owners, now you have a responsibility. As a practical matter, the law says at that point, you can have an informal, cheap appraisal, a cheap valuation done 2 or 3 years, but every couple of years, every 3, maybe 4 at the most years, you really need to get a full-blown, serious appraisal done. If you don't, you may be in breach of your fiduciary duty, and if your valuation is wrong, the penalties of the valuation may be very high. So bottom line, always file the 1120 for the corporation and the ROBS. Always file a 5500 for any 401k. If it's solo, you can self-value, but you need to document how you got to the value, and it needs to be reasonable and in good faith. Once you start engaging in certain transactions, converting to Roth, issuing RMDs, required minimum distributions, which usually happens in your 70s, or once you have employees who are not owners and not married to owners, your responsibility is much higher. At that point, the best practice, and really even just the practice to cover your rear, is a formal appraisal, let's say every 3 years, and a light appraisal or a light valuation in the intervening years.